and welcome to the Income Generation. I'm David Scranton, your host. Each week we provide you with information, thoughts, and financial remedies to give you greater perspective on many of the challenges facing those in or approaching their retirement, and more importantly, workable solutions. This week we have a great show lined up for you. Marty Johnson will be here a bit later on to give a report I'm sure you won't want to miss. And we're going to have a discussion with a very special guest I'm sure you'll recognize on topics ranging from what the Fed's next interest rate moves might be, to prices you'll be paying for things, to what actions you can make now to prepare yourself for tomorrow. Last week, we had market analyst and business news personality Tobin Smith, and he discussed companies with cutting-edge, game-changing innovation which could give their investors well above average growth in the stock market. We warned that investing in transformational growth companies, as Toby calls it, isn't necessarily for all of our viewers, but may be worth considering for those with an additional 5 or 10% in their risk-based portfolio. For those members of the income generation with some risk in their portfolio, they have a choice of either investing with a target of average returns by placing index assets in an index fund, for example, or they can look to beat the average with opportunities shared by Tobin and his company, the next big thing. I'll caution you again, however, that these investments are not best suited for all viewers of the income generation, but as always, we're exposing viewers to understand the many different opportunities available to you. Throughout 2015, all eyes were watching and waiting to see when and if the Federal Reserve had room to notch interest rates upward. And we got our answer to that earlier this month. Now the talk is shifting toward what to expect in and throughout 2016 in terms of interest rate targets from the Federal Reserve. And there's always some talk about inflation and employment because of the impact that they both have on overall economic vibrancy. The question is, will the market withstand higher rates or will it collapse under the pressure? My guest today is the perfect person to help us with that question and with many others related to the economy. Professor Peter Morici of the Robert H. Smith School of Business is a recognized expert on economic policy and international economics. Before becoming a professor, he served as director of the Office of Economics at the U.S. International Trade Commission. He is the author of 18 books and monographs and has published widely in leading public policy and business journals, including the Harvard Business Review. He also has lectured widely and provides executive programs at more than 100 institutions, including Columbia University and the Harvard Business School. His views are frequently featured on CNN, CNBC, and right here at Newsmax, as well as other top-ranked national broadcast networks around the world. The question is, will rising short-term interest rates be cataclysmic? Will hiring continue? Will real estate prices tumble? I'll be sure to ask Peter Morici those questions and more. We also have Marty Johnson reporting on some very interesting relationships between interest rates that many don't think about very often. But this is ultra important because the income generation has been a victim of massive Federal Reserve stimulus. What do I mean by that? The victim of massive Fed stimulus? Well, low short-term rates may be welcome. In fact, low long-term rates also might be welcome if you're a borrower, such as someone purchasing a new home on credit. In those cases, you might benefit from essentially cheap borrowed money. But the income generation is more likely to be savers, and saving rates have been dismal. In fact, virtually non-existent, at least at your local bank. So for you savers, like many that ask me for help every day at my firm, Sound Income Strategies, those who had previously positioned themselves to count on higher interest on savings to help fund their retirement, they've had to tighten their belts and maybe just plain do without. The reason, of course, is rates have gone from 4 or 5% to near zero. Fortunately, the Fed moving to raise interest rates will have a positive impact on these savers. My clients, most of whom are invested in non-stock market income generating investments, have done well by investing for their goals, so they can be more at ease with regard to the future. But a return to higher and more normal shaped yield curves would make them even happier. So let me talk a minute about how low rates have been helping. Extremely low interest rate policy has been very good for federal government, which is always borrowing. In fact, rates on some short-term maturities, and for the U.S. Treasuries have slid below zero several times since 2008. In fact, they were below zero as recently as October of this year. So how much does the government benefit? On December 1st, 2015, the U.S. Treasury had total debt outstanding of more than $13.5 trillion. An increase of just half of 1% would cost the government an additional $67.8 billion each and every year. It's also been a big help to the real estate industry and the auto industry, as well as banks and financial institutions. The artificially low interest rates have also helped people with new mortgages or car loans. Although it does not help, as many young people have discovered, if you can't qualify for the loan to begin with. But low interest rates, for the most part, have been distressful for the income generation. So the Fed's move on the 16th, regardless of how small it may seem, is a step in the right direction for those of you out there who've been suffering with assets that are not serving their original purpose, which is to throw off income. The statement the Fed gave after the meeting indicates they don't feel as though they're finished increasing interest rates, but will be patient and prudent as they try to guide us back to normalcy. In my view, although I don't hear anyone else talking about this, I suspect the Fed can't keep raising short-term interest rates. I've said this before on national television, and later we'll talk about the logical reasons why they can't. I think when you see this, you'll agree with me. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. As we all know, one of the most debated questions in the financial world, ever since quantitative easing, or QE, ended back in October of 2014, has been the following. When will the Federal Reserve readjust short-term interest rates? The Fed first took the unprecedented step of lowering short-term interest rates to near zero back in 2008 in their first desperate attempt to artificially revive the economy. I said in a newsletter back in May of 2008 that once they saw near zero short-term rates not doing the trick, they're probably going to have to resort to increasingly desperate measures that are completely unprecedented. What's important to understand is that the Fed can only set short-term interest rates. Long-term interest rates, on the other hand, are driven by market forces. They cannot be set, but they can theoretically be manipulated by artificial means, and that's exactly what I expected the Fed would try to do. Sure enough, soon they announced the $3 billion Cash for Clunkers program. By the end of 2008, they launched the TARP bailout, aka the first round of quantitative easing, or what we now call QE. This is all in addition to keeping short-term rates near zero. At that time, with QE1, or the TARP program, they began purchasing $600 billion in government bonds and mortgage-backed securities, essentially printing new money and putting it into circulation. With these artificial economic steroids, as I like to call them, trying to pump up the economy, unfortunately, it didn't work exactly like it was supposed to. So what did they do? They kept injecting. In 2010, they came out with QE2, followed by Operation Twist. Then in 2012, they came out with QE3, which we called QE Forever, because it included buying back $85 billion per month of government bonds and mortgage-backed securities, all with the aim of manipulating long-term interest rates downward. Throughout all this, still holding short-term rates near zero. The idea being that long-term interest rates would give consumers business incentive to borrow, which helps drive the economy. But 7 years later, with the Great Recession supposedly behind us, the question is, why are short-term interest rates still near zero? Why have they been that low? There are really two parts to that answer. First, quantitative easing didn't really work as quickly or effectively as the Fed might have hoped. In fact, after two major stock market crashes since 2000, as well as the collapse of the housing market, Americans weren't easily enticed into borrowing more money just because interest rates were low and they could afford to do it. In fact, the last quarter of 2013 marked the first time since before the start of the Great Recession that household debt actually increased over its previous levels. Prior to that, Americans were more focused on paying down debt and saving and investing. This is all according to a recent survey that many still are in that mindset today. Most have little choice because they haven't had a pay increase since 2007, and the median household income is still below where it was 10 years ago. The result has been a much slower economic recovery than Washington would have liked. This is why quantitative easing stayed in place through 3 rounds and for 6 full years. Additionally, even though quantitative easing did officially end in October of 2014, the Fed has really had little choice but to keep short-term interest rates near zero ever since. There's a basic mathematical reason for this. At the very same time that our government was tapering QE3, the global economy was taking a dramatic turn for the worse. Greece and Argentina were grabbing most of the headlines, but all across Europe, the financial markets were in crisis. Because of that, we were suddenly the bright spot in the world economic situation, even though our economy hadn't yet been fully weaned off quantitative easing. The analogy I used at that time is that we're now the cleanest dirty shirt in the world's economic hamper. As a result, many global investors turned to U.S. Treasuries as their best option for any kind of returns. This helped buoy our stock market and stave off a potential steep drop as quantitative easing wound down again at the end of 2014. Now, at the same time, Europe announced the launch of its own quantitative easing program to artificially drive down its long-term interest rates. Almost instantly, this created a leveling effect that kept our long-term rates from springing back up, holding our 10-year Treasury rate, for instance, down around 2% throughout most of that time. Just over a year later, this leveling effect is still firmly in place and could work to keep our long-term interest rates suppressed for a long time to come. What that means for the Federal Reserve is that it almost has to keep short-term interest rates reasonably low or it will risk flattening out the yield curve. A flat yield curve is a major inhibitor of borrowing, and since spending and borrowing are essential to a growing economy, flattening a yield curve would run counter to all the objectives behind quantitative easing and economic recovery. We're going to talk about yield curves a lot more throughout this show today. A flat yield curve hinders borrowing. Banks depend on the yield curve to make loans. They pay interest to depositors based upon short-term interest rates, but they collect interest from borrowers based upon longer-term interest rates. Therefore, they need long-term interest rates to be higher than short-term interest rates. Otherwise, it just doesn't make lending money a good business decision for them. So as this European leveling effect continues to hold down our long-term rates, it seems pretty clear that the Fed really cannot raise short-term interest rates by very much without further hampering the economy's post-QE recovery. And as we all know, that recovery is still moving along more slowly than they like to admit. For whatever reason, most analysts and experts seem to overlook the yield curve issue when they're debating this question of will they or won't they or when they raise rates. I first started talking about the Fed's dilemma as far back as a year ago, and even mentioned this several times early in the year when I appeared as a guest on CNBC and other national news shows. In connection with that, I've also been talking for a long time about the possibility that we may just have entered a period in our history where low interest rates are here to stay, which is not unheard of. Japan, for example, has been in a low interest rate environment for over 20 years now. It's important for investors to know whenever they hear some analyst or broker talking about the inevitable bursting of the bond bubble, meaning the idea that interest rates are going to go up and bond values are going to come crashing down, they talk about it almost as if it's inevitable that rates go up. Now, that may have been the normal course of economic ebb and flow in the past, but as many economists have pointed out recently, the long-term effects of quantitative easing may have created what they call a new normal that is still in the process of taking shape. Indefinitely low interest rates overall could be part of that new normal. One thing that does seem certain is that the overall trend in declining interest rates that began in this country back in 1982 is probably ended now. Interest rates are at a point now where it would appear they either have to stay put or eventually start easing upward again. While the 10-year Treasury rate may not get back to 5% anytime soon like it was pre-1987, its downward trend probably ended in conjunction with the tapering of quantitative easing. The good news for investors is that whether interest rates stay put or whether they do start rising eventually, long-term interest rates specifically, there is an investment strategy that works well in either scenario without the risk of common stocks or stock mutual. All right, we're here on The Income Generation with famed economist Peter Morici. Peter, welcome to the show.
Nice to be with you.
Great. Listen, I've got a bunch of great questions today for you, so I want to just get right into it and get started. The first one has to do with inflation. Our generation, we call the income generation on the show, as you know, has been struggling lately because interest rates have been so low. So when they depend on interest from savings and investments, it's been more difficult than ever before. And in addition to that, their cost of living increases have not been significant at all over the last decade. What are your thoughts about the CPI as an accurate indicator for inflation overall?
Well, the CPI is an average. They look at what individuals buy. You spend 10% of your income on gas, 22% on groceries, that kind of thing. And then they do a weighted average of the price changes. They do an average. Unfortunately for older people, they tend to use those services that go up more rapidly than average, such as health services, in much larger quantity than young people. So they feel the burden of inflation. If inflation is 3% and Social Security is adjusted by 3%, they're probably still losing ground because the inflation they experience is 4 or 5. So even with zero inflation outside, theoretically, they're feeling a heavy burden. For example, their health insurance costs are going up this year, but they're not getting a boost in Social Security.
Right. Well, that makes sense. We all know younger folks have an advantage if they're still making mortgage payments. Those mortgage payments are generally locked in. So the CPI index in some ways is more generous than what they really need. But you're saying it's the opposite for members of the income generation, especially for retirees.
Absolutely. Consider this. A nice chunk of the CPI is gasoline because so many people commute to work. Well, if you ride the subway because you live in Manhattan or Brooklyn, the price of gasoline is virtually irrelevant because you only drive on weekends, if that. If you're an older person, you no longer commute, so your driving is much less than, say, the typical 35-year-old family with 2 kids playing soccer. You're driving all over the place. For them, gasoline's really important. With gas prices falling, the CPI comes in at 0, but that elderly couple is much worse off. The young couple is much better off.
Yeah, makes sense. That makes a lot of sense. Now, let me switch gears just a moment. Each October or so, it seems like Republicans and Democrats are fighting over whether or not to raise the debt ceiling. One side argues it's irresponsible not to. The other one argues that continuing to raise it is also irresponsible. In your expert opinion, what would happen if they did not raise the debt ceiling and instead we had to live at the current legal debt ceiling level?
First of all, raising the debt ceiling isn't for financing the bills we've already racked up, as the president claims. The reality is the bills that we've already racked up are financed by bonds that already exist, and they would be honored. The reality is, though, is that Mr. Obama would be limited to spending only as much taxes come in, so it would force a balanced budget almost immediately. That is a manageable proposition. So to say the Republicans are irresponsible is absurd. But unfortunately, who's ever president of the United States gets to set the terms of the debate by virtue of the bully pulpit, and he's got America convinced that somehow that we're going to renege and welch on our debts. Nothing could be further than the truth. The only person that can determine whether we renege or welch on our debts if we don't raise the debt ceiling is the President of the United States. So I guess his credit would be bad with me once he's out of office if he wants to borrow some money, because it's really clear that he doesn't think the paper that he puts out should be honored, because he'd have every available opportunity to do that. We'd have lots of tax revenues, Social Security checks. The president says, oh, golly, if we don't raise the debt ceiling, the checks don't go out. That's nonsense. If we don't raise the debt ceiling, you will still pay Social Security taxes, withholding tax on your paycheck. That cash will be available. Sophistry, demagoguery, outright distortion, lying. It's impolite to say the president's lying. Let's just say he's terribly misinformed by those liberal economists who surround him.
Yeah. Well, in a nutshell, then, you're saying that you don't think it would be a half bad idea if we just said at one point, enough is enough. We can't raise the debt ceiling any longer.
Well, it would be disruptive to do that because you have to decide where the cuts would be. Now, given the situation that we live in and the way the president likes to spend his money, sending the IRS out to ferret out
the way he likes to spend our money is what you mean.
Scrutiny, and basically sending an army of lawyers out to local school districts to find discrimination where it doesn't exist, and financing the military. Where do you think the president would do the cutting if it was left to him? Unfortunately, if we did not raise the debt ceiling in a crisis, which is what would exist, the choices would have to be made. I wouldn't trust the president to make those choices, but that is exactly who we'd have to trust. The reality is the president uses this as a wedge issue to keep from taking a hard look at the places where he absolutely wastes money. For example, in the Department of Education, of which I have some expertise, there's plenty of waste and political payola going out, simply financing intellectuals at universities who, frankly, don't like the viewers' values that are watching us right now.
You're the first economist I've ever heard use the word payola, but I guess you need an Italian economist to use that word, so I guess that fits. Peter, I'd like to switch gears again just a moment to something that's near and dear to my heart. My big concern that I've had for a long time is the government's ability to raise the long-term end of the yield curve. With all the easing going on in most of the Western world, they raise short-term rates. I'm concerned about the yield curve flattening out. So what tools do they have at their disposal to actually raise the long-term end of the yield curve?
Well, just as they bought government bonds to lower the end of the yield curve, they could start selling them. The Fed has got a huge balance sheet, so for a considerable period of time, it could sell bonds to accomplish that. It's tough. And the reason being is that there's an infinite appetite for American bonds, abroad. And so the Fed does have its balance sheet that it could use to try to, raise the rate. The question is, how much effect would it really have on U.S. capital markets?
Sure.
I expect that, any raising of the close end, the federal funds rate, would have the consequence of mostly raising rates on the short end of the yield curve.
Peter,
things like car
Peter,
loans.
let me interrupt you for a second. I apologize. We need to take a quick commercial break here. But we're going to continue this discussion in just a couple of minutes. We'll be right back with Peter Morici. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. We're here today with well-respected economist Peter Morici, and we're talking about how much control the Federal Reserve has or doesn't have about increasing interest rates on the long end of the yield curve. Peter, I had to cut you short there for our commercial break. If you want to finish your thought, that'd be great.
Well, let's give an example of Ben Bernanke raising the short rates, raising the federal funds rate in the last decade. When he did that, there was very little consequence for long rates and mortgage rates, simply because although the Fed was raising the short rate, there was so much money coming into the country. Basically, the Chinese buying U.S. government bonds, the Chinese government to suppress the value of its currency, that it has no consequence for longer rates, say the 10, 20-year treasuries and for mortgages. That is likely to happen again now, not so much because the Chinese government will be buying the bonds, but Chinese private investors are getting very nervous about the stability of the Chinese economy. And after all, if you're interested, you've created a lot of wealth in China by exporting all kinds of T-shirts to the United States. You have a lot of money now, and you want to pass it on to your children. Where do you want it? Do you want it in Chinese bonds or American bonds? Where is property more secure? You know, one of the reasons that universities in the United States are stuffed with Chinese foreign students is not so that they can learn engineering and go back to China and build dams. It's that so they can come here to live for good, and they want to take their parents' money with them. Given the chance to buy U.S. bonds, they will. And given that, it's unlikely that raising the short rates, by the Fed will have a big consequence for your mortgage or what you can get on a 30-year Treasury security.
Okay. Now, you said they could sell long-term bonds, some of the ones that they've bought back already. They could put those back in the market, and I understand that. But we have Europe now with all their easing that are keeping interest rates low abroad. So it's going to be difficult, even if they do sell some of these long-term bonds that they're currently holding. It's going to be difficult with what's going on in Europe. Isn't that correct?
It is very difficult to run American monetary policy independently of what goes on in Europe, and even more so with regard to China, because it targets its exchange rate through a variety of mechanisms, not just buying and selling U.S. bonds, but also through its capital controls. You know, it's very hard for General Motors to really own a factory in China 100%. So we do have limited policy independence, and economists have always known this. Now, this is not some sort of great conspiracy. This just comes from globalization. Globalization makes us more independent. Well, it also tends to unify capital markets, which means it does limit the ability of central banks to influence what goes on in them. And longer term, you really can't solve the economy's problems with monetary policy alone. We have gotten all we're going to get out of easy money. The real problems with employing people in America is the high cost of employing them. For example, you know, if you're paying someone $7 an hour, $7.25 an hour to stand at a counter at McDonald's in Barack Obama's world, you're also going to have to spend $8,000 or $9,000 buying them health insurance. And if they got a family, more than that. That dramatically increases the cost of labor. And that's why we're really not creating jobs here. That, along with misaligned exchange rates.
Now, Peter, while we're talking about that $7.25 an hour, you know, we're always being told the income discrepancy between top earners and the bottom is widening. But the question is, you know, if it is in fact widening and both categories are improving, then should we really be concerned about this?
Well, I think progressives ought to be concerned, or liberals, they ought to be darn concerned. One of the reasons it's widening is the process of globalization makes Americans that can sell their services internationally more valuable, and those that do similar kinds of things. So we see the earnings of a corporate lawyer going up, or the people that trade on Wall Street going up. At the same time, because of globalization, it's not just the guy who makes auto parts in Indiana whose wages are pushed down by Chinese competition, but also the woman that waits on tables at the diner across the street. It pushes her wages down. Now, the great advocates of things like NAFTA and TPP and so forth are the Democrats. That's what invents, you know, this income inequality thing. But they have sort of turned that around. They've sort of forgotten about that connection, even though economists like Larry Summers teach that connection as a matter of fundamental economic theory, you know, at Harvard. I mean, that's fundamental economic theory. It's called factor price equalization. It's a basic theorem in economics. But yet they forget that. Instead, they talk about income inequality as something that came out of the Old Testament. It's something that came out of Babylon. And it's this conspiracy of the wealthy, Republicans, to somehow or other impoverish the working American. Income inequality, and then they blame everything on it. For example, just the other day, ISIS was now caused by income inequality. You know, the next thing we're going to hear is that the Ice Age was caused by income inequality among the dinosaurs. Certainly, it's responsible for the cold Canadian winters in their minds.
Peter, I could tell you're really questioning your political affiliations at this particular point in your life. I've got one final question for you that it seems to me as though I can't even make that comment with a straight face. In the minute or so we have left, it seems to me as though that Janet Yellen doesn't have the same control over monetary policy decisions that other Fed chairs have had in the past, such as Alan Greenspan and so on and so forth. Am I onto anything here, or am I way off base?
Well, when you have a Fed chairwoman who starts making comments about income inequality during a presidential campaign, it's hard for her to maintain sort of the standing that she's politically unaffiliated. That's the first thing. And the second thing is, according to Democrats, you should always have easy money, the easiest of money. If I could put $50 bills in B-57s and fly them over Boston and see to it those bundles of $50 bills only landed in minority neighborhoods, then the Democrats would be complaining we just don't make B-57s big enough. Now, it is hard to accomplish a consensus and unanimity on monetary policy when you run around the country and say emotive things about income inequality and then expect to pull your liberal members along when economics says you should tighten. See, Janet Yellen is really a conflicted personality. She's as liberal as Nancy Pelosi politically, but she's compelled by her profession to actually be responsible. And it's very hard for such a conflicted personality to accomplish consensus among the Fed Open Market Policy Committee. There's that, and also just over time, because of this push for greater transparency, we're probably more aware of conflicts than we would have been in the past.
Great. Well, we have to leave it there, Peter. Peter, I want to thank you very much for being on the show today. And you heard it right here. Peter Morici said, well, thank you again. You heard it right here. Peter Morici says, Hillary Clinton for president 2016. We'll be right back with Marty Johnson. Stay tuned.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Marty, thank you for your insight as usual. I want to take a moment now and provide our viewers with some definitions to eliminate any confusion there is about this concept of yield curve. Income on an investment, or what's called its yield, is the annual percentage that investors paid based on the investment's cost. A yield curve is a line graph of various interest rates offered at increasing maturities for fixed income securities. It illustrates for us what investors get paid at different end dates of similar credit risk. The yield curve, what we call the yield curve, these things are used by investors and other market participants as a visual way to compare rates. Like most markets, the levels are indicative of supply and demand forces, but more importantly, they're used as an indicator of expectations of future interest rates. The steepness of yield curve, or the differences in interest rate levels, are what create the slope or the shape of the yield curve. Most often, yield curves have sloped upward. This is called a normally shaped yield curve, or a positively sloped yield curve. Why? Because historically, yield curves typically have shown increasing rates as maturities get longer. So a normally sloped yield curve is slanted upward. This also means the longest maturity securities typically offer the highest income, while the shortest maturities offer the lowest income. In addition to a normal upward sloping yield curve, yield curves can sometimes be downward sloping, with rates declining in longer term maturities. At times, flat yield curves can also exist. A downward sloping yield curve occurs when rates are forecast to decline and stay down. This can occur because investors want to lock in longer maturities, even if it means taking a lower interest rate. Why? Because they expect that they'll earn more than if they invested short term and had to reinvest sooner at a much lower yield. For example, if an investor is looking to receive the highest interest payments and rates are supposed to decrease over time, or at least forecast to decrease over time, investors may be willing to accept a locked-in rate out long rather than accept a higher short-term rate that will have to be reinvested in the future at a much lower rate. What's important to that investor is maximizing interest payments over the long term instead of getting paid the highest interest rate today at a future sacrifice. Now, reading yield curves is kind of like an art. Every yield curve is in a way telling investors a story, something about the future expectations of interest rates, how much they should be paid in order to increase risk, what the collective wisdom of the market believes will occur at various time frames, and how much fear or confidence investors are experiencing. This normal upward sloping yield curve, again, which typically occurs, is most often when the economy is growing and investors wish to be compensated for investing long term. Why? Because they're foregoing expected future higher rates by investing long now. Or if inflation is expected to increase, investors will want to protect themselves against the decreased purchasing power by locking in higher yields today. An inverted yield curve, on the other hand, occurs when long-term interest rates fall below short-term interest rates. Although it doesn't happen often, an inverted yield curve may suggest that investors expect the economy to decelerate or even experience negative growth in the future. The reason? Slower growth is usually met with Fed stimulus in the form of lower short-term interest rates. And low or no growth is typically accompanied by low inflation, so investors don't require some kind of offsetting high rate to compensate for that inflation hedge. An inverted yield curve, at times, has been a precursor to a recession. Investors are willing to accept a lower interest rate in return for being locked in for years to come. Although we've only scratched the surface of yield curves in their analysis, we've hit upon some important basics which allow us to best understand our investment advisors, economists we read and hear, and others that are telling us when they show concern for, let's say, an inverted yield curve, and comfort from a more normally sloped yield curve. The yield curve right now is upward sloping, but much less so than its steeper historical average. The question is, what would happen if the Fed regularly notches up short-term interest rates and the longer-term interest rates stay put because the economy isn't expected to increase or we're not expected to have inflation? One of the Federal Reserve Bank's mandates is to maintain a healthy banking system. As I mentioned earlier, an inverted yield curve would leave banks paying short-term rates on deposits, higher short-term rates, and receiving low long-term payments on longer-term loans. That obviously is unhealthy, it's unsustainable, and would likely put banks back into crisis. I believe this would happen quickly because much of their longer-term loans are already at very low levels from the last few years. Higher short-term rates could have banks lending at lower rates than their borrowing costs indicate. That's a likely recipe for disaster. So the Fed may have its hands tied as far as what it can do. Also remember, lower rates and quantitative easing prompted investors to buy more stocks, more real estate, and other risky assets. What would happen if investors are comfortable on CD interest rates or treasuries? Money would first most likely move out of liquid assets like stocks and could cause stocks and stock fund prices to fall off a cliff. Something to ponder, for sure. Today, had an opportunity to sit down with economist Peter Morici, and he outlined some of the risks and challenges the economy has faced and will face in 2016. You can follow Peter on Twitter at pmorici1 or follow his Newsmax blog. I think we need to go back and retape that Newsmax That's good. Right there. Today we got to sit down with economist Peter Morici, and he outlined some of the risks and challenges the economy has faced and most likely will continue to face in 2016. You can follow Peter on Twitter at pmorici1 or follow his Newsmax blog. I also want to thank Marty Johnson for her report. Marty always manages to tie a lot of useful information together, increase your understanding, and I've heard from our income generation viewers that they want to thank her for filling some knowledge gaps that they didn't even know they had. Next week, we're going to have Dan Gaynor joining us. Dan is an officer of the Media Research Center, which, as you well know, is the watchdog for truth in media. We're going to talk with Dan about how open and unbiased the investment news is, among other things. I'm personally looking forward to that. If you haven't signed up for a complimentary special report titled The Income Generation, which allows readers to discover many answers to their investment questions, you can sign up now at theincomegeneration.com. You'll discover a wealth of useful ideas you can put to work to better secure financial security. That's all for today. I'm David Scranton, and you've been watching The Income Generation. We'll see you all again next week.